Good morning and welcome. Welcome to the 36th Annual College of Business and Economic Outlook Conference. My name is Wayne Fox, and this is new. I'm also the director of the Alliance Bank Business Outreach Center. We're very pleased to announce a new partnership with Alliance Bank. We started last summer. That partnership is part of the reason this is sponsored by Alliance Bank. And in addition, the partnership also will allow us to do more initiatives to advance the economy of not only the region but the state. Now it's my great pleasure to introduce Craig Van Slyke, Dean of the Franke College of Business, who will serve as your moderator today. From firsthand, he has a tremendous focus on the student experience, and that one of his other priorities is to engage the business community.
Wayne asked me to give you a quick update on kind of the state of NAU. Things are much better. The state budget has not been finalized yet, but it's looking better than it has, and quite a even better news is the enrollment. Key to dealing with uncertainty is information. And that's the whole point of today. So our first speaker today is Dr. Ron Gunderson. He's going to speak to us and give us some clarity on what we might be seeing in the near future.
Clearly, as the Dean said, we've spent a lot of money and listened to a lot of ads over the last year and a half, and we pretty much have the same players going forward for the next 2 years as we have for the last 2 years. And we spent a lot of money to do that. You probably ask, did we get our money's worth out of the last 2 years? And you probably think, well, no, maybe not, because it seems like it was almost like a do-nothing Congress, and the President and Congress didn't get along, and things hadn't gone very well. But when you think about it, they really did something. They did something that'll happen by default, and of course you'll hear a lot about it today. And of course, that's put in the legislation basically that'll kick in January if they don't address the issues related to the fact that things that we have to look at. And I don't think it's the political party that is in power that is going to have to necessarily make these fundamental changes. That is, these changes are going to happen, and they're going to be addressed by all of us, not just a particular party. So we have to look at it. One of the things that gets in the way, though, I think, in the last few years has been ideology. That is, it's replaced politics. If we don't address this fiscal cliff, if we don't get over this ideology, we're going to have a recession, and I can guarantee it. However, there is one other concern that I do have, and that is that we do have to pay attention to the redistribution of income. And there are some other disturbing figures that have come out in the last year or two. The workers' wages in the economy have dropped to about 57.5% of the overall income. And that's about 12% below, or 1/8 below, the figure that had existed for decades. That it's math, not politics, that might get us out of this solution. He says, first of all, some observations. He said, we want to retire early and we want someone else to fund it because we don't want to save anything. He says we want more social programs, no taxes, and freedom to conduct our affairs without regulation. He indicated that we want a highly technical, modern society, but we desire to spend anything. We don't desire to spend anything on the decaying infrastructure, such as the schools and the highways and other things. We want economic adjustments to be borne by someone else. Basically, he said one party won't stop spending and the other one won't raise taxes. The way out of the financial quandary is not solved by electing anybody. The American people themselves need to change, and serious behavior modification is over. Good news in the economy. That is, if you look at what's been going on in the last few months, a lot of the indicators have turned up. That's why, on balance, I am going to be slightly optimistic for this coming year, assuming we address the issues of the fiscal cliff. New home sales are higher, employment is increasing, retail sales are higher both at the national level and in Arizona. Manufacturing is increasing, consumption spending has been construction spending has been improving, and consumer confidence is...
Another couple of areas of great concern are interest rates and inflation. And if you're contemplating buying anything big, they're weighing heavily on your mind. Dr. Dennis Foster is going to speak to us about that.
This chart shows economic growth, real GDP, that's occurred in each quarter since 2000, expressed on an annual basis. The red line shows zero economic growth, and you can see the last two recessions are marked here, 2001 and 2008. And you can note the severity of this last downturn. And then here's our current recession. You can see that the rising unemployment rate was rather quick, and the decline has been excruciatingly slow. Indeed, if you look at that line, it looks like it's going to converge with the 1981 line, which bodes real ill in terms of how long it's going to take to get unemployment back down to 6% or 5.5%. Since our recovery began, inflation has crept back up. It's bounced around a little bit. Currently, it's running at about 2% over the last 12 months. And the Fed is certainly not acting as if that's an imminent threat to the economy. And while it's not a problem right now, there have been actions by the Fed that are extremely troublesome. For this recession, they've pushed the rate, for all intents and purposes, down to zero. And there's nowhere else to go. It's a policy dilemma here. Well, for a couple of years, I've been telling you that the worst of all possible worlds for us is robust economic growth. It's probably not the thing you want to hear from economists. But I still stand by that today. I'm afraid our best hope still lies in years of slow, sluggish economic growth. So what else can we say about regime uncertainty today? Well, there's a lot you could go into in terms of this topic. I'll leave you with just a little taste of it, which is the fiscal cliff scenario that you've heard a little bit about earlier today and probably have read about. Here are some of the details of that fiscal cliff. The expiration of the Bush tax cuts, expanding the alternative minimum tax, reducing Medicare reimbursements, there's sequestration, spending cuts, expiration of some unemployment compensation, and some taxes kicking. The Congressional Budget Office has estimated the effects of this fiscal cliff will, in fact, reduce the deficit, and they also think it will cause a recession in the spring, leading to a 3% decline in real GDP and the loss of some 2 million jobs. Now, this may or may not actually happen, and that's almost beside the point, because the real point is that the economic landscape is so muddy, is so confused. I don't know how anybody can make rational business decisions in this environment. Of course, business turns out to be very resilient, bounces back pretty well, and that is to our great fortune. Here's my outlook. Pretty grim, I'm sure you understand. I think interest rates will stay low. The Federal Reserve says they're committed to keeping these rates low through 2014. Even though the data is not showing any inflation, I think it's still a looming danger. The problem is once it starts, is it just going to catch fire and be impossible? Unemployment is likely to improve, but not in any dramatic fashion. Even the best case scenario is still pretty bleak. I still think there's a lot of issues of regime uncertainty here that are likely to dampen inflation and may well pull us into a recession.
Elliott Pollock has been doing this for a number of years as well. He's the CEO of Elliott D. Pollock & Company, an economic real estate consulting firm in Scottsdale.
See, this is GDP since 1970. The only reason I'm showing this in is you can see that this recovery, by any historic standard, is weak, and we'll talk about that. But at least we're growing, and so it should continue, but it's going to be continued at a subpar rate. We'll talk about this. Consumers' spending is going to be up, but it's going to be modest. Business spending is going to be up, but because there's excess industrial capacity, it's not going to be up rapidly. There's going to be a continued housing recovery. You're going to get large percentage gains, but they're small in numbers because we're down so far. Limited commercial construction, continued pressure on state and local government, and again, as far as I'm concerned, the federal government has very few policy options left. I don't know where they go from. Let's talk about consumers, all right? Good news with consumers, they've been deleveraging like crazy. In the last 4 years, consumers paid down $1.7 trillion in debt, and the financial obligations ratio is down to levels that you haven't seen since the early 80s. Business has paid down $2.9 trillion in debt over the last 4 years. They're in really good shape. Corporate profits, while they're off the peak, are very brings us to the problem sector, government, okay? There's a tipping point. There's a point, you know, we've gotten a free pass because we're the world's reserve currency, and there's no alternative. And people still send their assets here in times of uncertainty. But at some point, that will change. The problem is, it's just like the housing bubble. You know it's a problem. You don't know when it's going to. Same thing with the world basically saying, we don't want your debt anymore, or we want much higher interest rates to hold your debt. Especially since logically every other government in the history of mankind has inflated its way out of these problems, and I doubt that this one will ultimately. The reality is it's going to be painful. There's no easy way out, and nobody's going to be happy. You're going to have significant cuts in the rate of these mandatory programs. You have to. You have to have tax increases, but hopefully they don't hurt incentives. But you can't have significant cuts or tax increases in this type of weak environment because they'll throw the economy back in a recession. It has to be phased in over a long period of time. It takes compromise and statesmanship, and those are two things that don't exist in Washington right now. I'm not optimistic. So the government summary is state and local under pressure. More revenues available this year. Federal government spending will be up but more slowly, and you need to avoid this fiscal cliff or all bets are off and we're going back into recession. I will also say very briefly, I don't think that Europe is going to throw us back into a recession. I think, you know, it's scary, but I don't think it's going to happen. Arizona and the U.S. economy move together. We tend to grow a lot more rapidly during periods of expansion, and I think that's the case now, although, as you'll see, even though by our standards it's very mediocre. In 2006, we were the second most rapidly growing state. By 2009, we were 49th. Last year, we were 23rd. We're all the way back up to 6th. Still grow, but it would be painfully slow. And it might even throw Arizona into recession. Hopefully, this never happens. In addition, U.S. Airways is about to, this never comes up, but U.S. Airways is about to merge with American. Where do you think the home office is going? Probably not Phoenix. The real tight markets are below $150,000. Who's in that market? Investors. That's what they're buying. And there are investors in Phoenix coming in buying 1,000 or 2,000 homes. To get to the long-term trend, by the way, housing prices have to increase by a lot. When will that happen? If all goes well, there's no fiscal cliff. 2015 or 16. Housing prices have a long way to go. There is a boom out there somewhere in Arizona, but not in 2013. Other things being equal, 2013 should be better than 2012. It should be up to about 3%.
Jim Lundy, who's the founding president and CEO of Alliance Bank of Arizona.
We really are pleased to sponsor this year's annual economic conference. As Dean Vince like said, we're now the 10th largest bank in Arizona. Featured speaker Robert Sarver. Robert, he's the CEO of Western Alliance Bank. Probably best known, though, to many of you here and to people around the state, he's the managing partner. Really has a 360-degree view of banking and also how banking intersects with the economy.
Glad to be here with you folks. You know, Elliot does a great job talking about all the economics and, you know, outlining a lot of the key issues, both locally and nationally, and actually internationally, because we compete in an international market. I'm hoping that the president, now that he's not running for re-election again, will maybe be able to move a little more towards the center and do some things to help get this economy going and get headed in the right direction. We're running a business, and I've been there, and you guys have been there before too. You're running a business that's as upside down as this government. You don't say, I promise I won't do this, I promise I won't do that. What do? You sit around your management team and go, okay, everything's on the table. We're going to look at everything. We're open to everything. What do we need to do to solve it? The tough things for us as bankers too has been, you know, we pride ourselves on being involved in the community. We pride ourselves on being good corporate citizens. We pride ourselves on lending money to businesses, being good people, having honesty and integrity, and we've had a tough few years. Speaking of a tough economy, and speaking of business being tough, and talking about what Elliot said, where it's a slow recovery, you know what? Slow times are difficult. You know, it's one thing to go through a tough year. It's one thing to go through recession for a couple of years. But when you're in a tough market or tough economy for multiple years, that really wears on you. And not only does it wear on you, but it wears on the people that work for you. A big sign right at the front door, it says no excuses. And at the end of the day, that's why we try to tell them. Get out of the locker room, we have a big wall that the players see every day. And we talk about what we call the 5 Ps, okay? The 5 Ps. The Ps are pride, preparation, perseverance, poise, and then if you do all those right, you get performance, which is the 5th P. So I'm going to talk just a little bit about those 5 Ps and kind of what they mean from a basketball standpoint and maybe how they can impact you a little bit, because I think you're getting plenty of information on what's going on, so I'm just going to kind of go off subject to say in a basketball season, it's a marathon, not a sprint, because there's 82 games. And I think what we're finding here with this economy is it's a marathon.
So now we have time for some questions from the audience.
Question for Elliot, and then some of the other panelists as well. Most of the comparisons to our positive economy that we're trying to recover to are from 2007. But as we all know, that economy was based on a false foundation. Wall Street failed in 2008 because we were betting on mortgages that had nothing behind them. And housing prices, had gone up really high all over the country, here in Arizona as well. But those prices are not sustainable because, again, they were built on a false foundation. So I'm wondering why we keep aiming for a false economy.
Well, no, we're comparing with, if you take a look at those charts, we're comparing the first 3 years of recovery to the last six recoveries. Okay? And as Dennis pointed out, historically, the worse the fall, the bigger the rebound, which is why the rebound after the 80 and then 81, 82 recessions are so great, so severe. This hasn't happened. So we're talking about mediocre growth in a period where historically you would have expected more rapid growth. There were simply structural problems. So I think no matter how you cut it, the economy is improving but weak, and there's a lot of reasons for it, but we're not comparing to just 2007. We're comparing to what you would expect normally out of the type of decline we had.
I'd also add that 2007 is still a meaningful benchmark because you have essentially full employment. Exactly what the mix of employment and production is the question I think that you're getting to. We don't need the same size of housing sector as we have been because of those kinds of issues. So we're still shooting for full employment. 2007 still represents that in the aggregate, but the actual composition of what people are doing presumably will be different and hopefully more sustainable.
Your question actually gets at something that's very important going forward, and that's that Arizona will be well off to try to build a more well-rounded economy than we have had.
Thank all of our panelists and Mr. Sarver for sharing their insights.